Hey everyone, in this video I'll be talking about the 8 deadly sins of stock market investing. These are some of the most common mistakes made by investors in the stock market, and I'm hoping that through this video all of us will form good investing habits so that we can survive and prosper in the marketplace. The content for this video have been compiled and collected through my personal research, as well as reading the book titled Taming the Money Sharks. It was a book written by Philip Cheng and it was published by Wiley in 2013. So I highly recommend reading this book. It's a very good book and it will help you become a better investor in the marketplace. Number 1, rushing into buying. This is a common mistake made by inexperienced investors, and it's mainly resulting from following one's temptation. The temptation to chase after something which is a hot stock or a hot asset, driven by a person's emotion. The mentality here is more of a speculative mentality rather than being based on any sort of fundamental analysis. We often see these types of mentalities and mistakes when it comes to initial public offering. For example, if you look at the average IPO return in the United States in 2018, what we see here is that a majority of the sectors actually had a negative return for the year. In other words, the price of the stock at the time that it was initially offered to the market substantially dropped throughout the year. So for example, an average IPO in the utilities lost almost 44% of its value through 2018, and similarly for energy and industrial, which lost more than 30% of their value. So with these IPOs, and this is often a common trend with the IPOs, basically a lesson that we can learn is, well, what if we do not rush into buying? What if we do more homework on those companies? And what if we really calm down and let the waves settle? And then if we believe those companies are worth investing into, then we can perhaps get into investing on them and get into buying them at a more reasonable price, probably at a much cheaper price in terms of the entry point. Similarly, in Australia, for example, we will see that more than 70% of the companies which were listed on ASX, which is the Australian Stock Exchange, those companies that were listed in 2018, 70% of them are actually in the red zone. In other words, their prices have dropped. And investors, basically in 20% of these IPOs, have lost more than half of their initial capital, which is huge. So again, the lesson here is calm down, don't rush into buying, and not necessarily for IPOs, for any sort of stock or any sort of assets. Do your homework and try to make an informed decision which is mainly based on fundamentals rather than sheer emotions. Number 2, not knowing the business or industry. Unlike shopping, investment requires focus. So it pays off to basically invest in an industry or a number of industries that you've got some basic knowledge or understanding about. Majority of inexperienced investors will try to buy a certain stock in a certain company as soon as it gets media attention without really knowing the industry. In other words, you're just trying to follow whatever is hot and perhaps even paying for an overpriced company. While diversification is important, we have to remember that if we do it the wrong way, in other words, by investing in companies which are outside our area of expertise, or at least in areas that we don't have any basic understanding of the industry, then it could be more damaging to our overall investment and portfolio. Number 3, following hot tips. Well, this is somehow related to a number of earlier mistakes highlighted today. The whole point here is, instead of just following hot tips by analysts and gurus and those so-called experts, try to first of all question what has been said. Try to question whether a certain upgrade or a downgrade of a certain stock really makes sense. Do your homework, do some readings, and through verification process, make an informed decision. Here is a snapshot of a famous tweet by Jim Cramer. He is the host of the Mad Money program. He said back in 29th of March 2019 that Lyft at a price of 87.24 is a good entry price. Later on I will show you why this became a very famous tweet, but I have to indicate that Jim Cramer is one of the best stock market teachers in my humble opinion, and he's a guru that I really follow and listen to his daily podcasts and episodes. But having said that, it doesn't mean that I'm going to follow his advice blindly, right? So I will always question that, and in this case, of course, I didn't purchase Lyft. So the message here is, regardless of who is sharing a hot tip, first do your homework. Here we see what happened to the stock of Lyft. So basically, once the company's share was initially offered, the price went as high as 88, 89, and then it has been on a free fall ever since. So those people who rushed into purchasing the IPO and basically even followed hot tips by the experts might get burned, because they haven't done really their proper homework, and they are actually purchasing a company which at the moment might be very highly overvalued. It doesn't mean that the price of the company, the stock price, is not going to get back to 88 or even beyond that. But what it means is, those people who rushed into buying and just followed the hot tips, they can see that the value of their investment has been dropping substantially. So we can see a 34% drop in value in the past basically couple of weeks in this stock. Number 4, not doing your homework. As an intelligent investor, you need to learn the basic facts about a company and its operations. The aim here is to avoid impulse investment decisions as much as possible. So the various sources that you can look into in order to do your homework would be the income statement, the balance sheet and cash flow statement of a company, as well as doing some readings about the company's maybe upcoming products and all those newspaper bits and pieces that are covering a company's operations. So typically in an income statement, I personally look into sales growth rate in terms of the percentage, the gross profit margin, the net income before tax, or even, for example, the net income after the tax divided by sales. When I look at the balance sheet, I'll look at the current ratio, the working capital, as well as the current liabilities divided by the total tangible net worth of the company. And finally, when I'm looking at the cash flow statement, I'm in particular looking at the net cash flow resulting from the core operations, as well as the net cash flow resulting from the core operations divided by the total net cash flow of the company. So in other words, ideally you are looking at a profitable business that can generate a substantial level of cash, which is higher than its industry peers, and has a healthy balance sheet, and again ideally has a sales growth which is much quicker or much faster in comparison with its peers within the same sector, of course. Number 5, not managing your risk. Everybody has a different level of risk acceptance. So you might be a person who is happy to take so much risks. That's fine. That might be your preferences. So in these cases, your portfolio might comprise of a more aggressive type of stock and asset allocation. Whereas if you are a person that you don't want to take as much risks, perhaps because of your personal preferences or because of your age, maybe you're approaching your retirement and you don't want to risk as much, then depending on that, your portfolio allocation, your asset allocation would be completely different. So these are important decisions that you need to make. But at the end of the day, it's very crucial that you have a strategy and a plan so that you can manage your risks. For example, I personally, when I want to, invest in speculative stocks, because we know that higher risk could somehow be correlated with higher rewards. So in these cases, I always make sure that my investment is in speculative stocks doesn't really go more than 20% of my overall portfolio value. I always try to maintain that percentage and never go beyond that. That's a certain risk level that personally I'm willing to take, but it doesn't necessarily have to be the case for everybody. I guess the message here is that understand how comfortable you are with taking risks and make sure that you've got a plan to manage your risks. Number 6, ignoring policy directions and trends. Well, we all know that, the stock market might be affected by macro events and those policy changes and directions that happen in the grand scheme of things. But inexperienced, investors might somehow ignore these issues and just rush into purchasing a certain stock because maybe they like it, or maybe they think it's cheap enough. Whereas if they look at the policy changes or the trends, the mega trends, if you like, that are happening in society, then they might perhaps make a better decision. So, just to relate to this, one of the mistakes that I made when I was more of an inexperienced type of an investor was investing in an oil and gas company. At the time, I started to invest in that company because I heard the rumors that the company was doing a new, exploration in a region nearby. I think it was Australia at the time. So they were doing a new exploration looking for oil fields. And I thought, well, this is going to be my lucky stock. I'm going to invest in this stock because if they find oil, basically, the stock price is going to, skyrocket, and I'm going to be rich overnight. Well, that turned out to be a huge mistake because, first of all, I didn't really know much about that industry. So we can actually see a number of these mistakes happening here. I didn't know much about that industry. I rushed into buying without really knowing the fundamentals of that company. Well, oil and gas, as we know, it's a sector that is, not really in favor anymore. It's a sector that is losing its momentum and it's losing its charm and favor. So basically, many of those companies have lost their value in the past, couple of years. This was a decision that I made maybe 5 or 6 years ago. I'm happy that I didn't really invest much in that company, but that was a costly mistake nonetheless. So I don't want you to make such mistakes. So make sure that you understand the policy changes and trends that are happening and invest in those companies that are really within your comfort zone and within your area of expertise or knowledge. Number 7, falling in love with your stocks. Regardless of how perfect you think a certain stock is, you might remember that you always want to do your homework about that company, and if you start investing in a certain company, you want to follow the company and its activities. You need to make sure that you're on top of that stock as much as you can. You regularly follow the stock market prices, its fluctuations, and basically we have to remember that the economical conditions and various factors determine the price of a company's stock. It's all about the laws of supply and demand. So we need to be aware of the consumer sentiments and various market factors which could determine the value of a certain stock. There is no point in having hope, bringing in emotions into your decisions, and also saying that, look, I know a company is perfect and I'm going to stick with that company forever. No, any company is valuable up to a certain level, and if the stock price goes beyond that, and if the company becomes overpriced, perhaps that might be a good idea to start selling your stocks, or at least maybe a portion of them. There is no point in falling in love with your stocks and never wanting to let go of them. And finally, number 8, maximizing wealth at the price of your health. We never want to compromise our health and our happiness just to achieve financial freedom. So there must be a balance between the two. In other words, we want to make sure that while we are still healthy and happy, we are setting aside enough money and investing it hopefully in a wise way, so that we can maximize our wealth, we can achieve financial freedom, but at the same time we maintain our health so that we can enjoy it. There is no point in becoming the richest person on planet Earth when you are not healthy and happy to enjoy it. There is no logic, or there is no sense in doing that. So it's very important that we make sure we maintain a good, healthy lifestyle away from stress. And a key to doing this could be making sure that we really manage our risks and we make informed decisions in our investment. There you have it, 8 deadly sins of stock market investing. Hit the like button if you enjoyed this video, and subscribe to the channel for more similar videos in future. Also, make sure that you write down your comments in the box below if you have any opinion or feedback about this video. Thank you.